Hey guys, welcome back to the channel. In this video, I'm about to give clarity on a question that is flooding the comment section of most of my videos, be it on YouTube or on Instagram. The questions are none other than what is the best time frame to trade the market, or what is the best time frame to use this strategy or trade that pattern, so on and so forth. So I totally understand that the traders who ask these sort of questions are especially those who are new to the market. And how am I so sure about that? The simple reason is that they are unaware of their own trading style. Now, let me break this down to you. Newbie traders often wonder if there is a perfect time frame that is better to trade than others. But the truth is, there is no single magical time frame to view the charts and make a profitable trade each time. So fundamentally, choosing the best time frame to trade will depend greatly on a trader's preferred trading style and the strategies used. So in this video, I will help you discover a time frame, or rather time frames, that you can make use for your analysis and for trading. So in that context, I will be discussing the following topics. We will start by determining the relevant time frames based on different trading styles. Then we will discuss the multiple time frame analysis by identifying the trend and trigger signals that you can make use of. And we will wrap everything up by learning how to use the multiple time frames to do general market analysis, to spot trigger signals and enter our trades. So please do like the video, and if you're new to the channel, please don't forget to subscribe. Okay then, let's get started. As you may already know, there are different types of traders and equally different trading styles with respect to the expectations, risk tolerance and time frames they trade. They may be classified into short-term, medium-term and long-term trading styles. The short-term traders includes the intraday traders and the scalpers. The medium-term traders are the swing traders. And finally, the long-term traders includes the positional traders. Now let us take a look at each one of them in detail to understand what their mindset is all about. So let us start with positional traders first. Positional trading is for long-term trades or expectations. So if you buy and hold stocks for several months to years, it is called as positional trading. Here the distinction between a positional trader and a long-term investor gets a little blurry. So most positional traders follow a combination of both technical as well as fundamental analysis before taking up a position. For positional trades, they usually look at the daily, weekly, and sometimes even the monthly charts. So in short, your objective is to capitalize on the long-term potential of a particular stock or a security. And if you do find a favorable setup using technical analysis or price action, then you will have to go deeper into the analysis of the business potential and the fundamentals of the company. Some of the positional trades can stretch anywhere between a few months to several years. Therefore, without understanding the business properly, it is difficult to get the conviction to give a large percentage of allocation for a particular stock in the portfolio. So, once you understand the business, you will gain the confidence to invest more and hold it for a long period of time. And this is one of the reasons why many new traders tend to avoid this approach, and also because it takes a long period of time before the trades are realized. But from what I have understood, the shorter the time frame and the expectation, the more noise and confusion arises in your trading. Now coming to swing trades. Swing trades are more relaxed in nature compared to short-term trading. They do not carry the pressure of finding new trades every day, and therefore the decision making is slower. So if you do not like watching the charts throughout the day, or if you don't have the time to do so, and also if you don't want to wait a long period of time to realize your gains, then swing trading is your best course of action. The most commonly used time frames for swing trading are the hourly and daily charts. So in short, if there is an opportunity for a swing trade, I usually end up analyzing both the hourly as well as the daily charts to understand the direction of the trend along with the important support and resistance levels. My advice is that if you are a beginner to the stock market and you wish to make trading your profession in the future, it's always better to start as a swing trader and gain experience. The reason why I say this is that you can significantly improve your risk management because you can have a higher margin for error and more time to make your decisions. But try to avoid small caps and mid caps for the first few months. Just stick to the Nifty 50 stocks and try to trade in small amounts. This way you can boost your experience and understanding of yourselves. So understanding your own nature is the most important thing if you want to become a successful trader. And this is one of the benefits of swing trading, that the traders can get the advantage of both the styles, that is a long term and a short term perspective, without necessarily taking on the downsides that come with these approaches. Now coming to day trading, intraday trading can be one of the most difficult strategies to master. Newbie traders implementing a day trading strategy are exposing themselves to more frequent trading decisions that may not last very long. So this combination of inexperience along with the frequency opens the door for increased losses. And as I have already mentioned, this can be prevented if the trader opts for a slightly longer approach like swing trading. Now, intraday traders can use time frames between 5 minutes and 60 minutes. The most commonly used are the 15-minute and the 5-minute time frames on the chart. In India, as you may all know, the market is open between 9:15 am and 3:30 pm. And the goal of an intraday trader is to find a favorable setup, take the trade, and exit on the very same day. These trades are usually held for a period of few minutes to few hours. So in intraday trading, you are faced with multiple decisions in a short period of time, and this can in turn lead to confusions, FOMO, and mistakes that can prove very costly. But the benefit that I see with day trading is that day traders enter and exit their positions on the same day, unlike the swing and positional traders, thereby removing the risk of any large overnight moves. So at the end of the day, they close their position with either a profit or loss. Now the last trading style that we will discuss is the scalping, which is the shortest form of trading. Scalp traders only hold positions open for seconds or minutes at the most. These short-lived trades targets the small intraday price movements. The most commonly used time frame for scalp trading is between 1 and 5 minutes. So it's up to you to use the 1 minute time frame on the chart or 3 minutes or 5 minutes. Now some scalpers also use a 15-minute time frame, but very few go beyond that. Now the purpose of scalping is to make a lot of quick trades with smaller profit gains, but the idea is to let the profits accumulate throughout the day due to the sheer number of trades being executed in each trading session. Now this is a fast-paced trading style, trying to grab onto as many points as many times as possible throughout the trading day. So it can be stressful for many traders and is hugely time consuming, given the fact that you need to focus on the charts for several hours at a time. On top of that, the scalper or the day trader is in a position where they need the price to move quickly in the direction of their trade, or they want the price momentum to be in their favor most of the time in order to make some profit. So therefore, day traders and scalpers become tied to the charts. Now, obsessing over the charts for a longer period of time can lead to fatigue. Along with that, the shorter term approach comes with a small margin of error, as these stop losses are placed on the shorter time frame, which leads to a lot of noise or price swings. So I don't recommend any new traders use this style because it can take a heavy toll on your psychology. It is always better to start with a relaxed phase of trading, and when enough experience and risk management are gained, you can eventually step down your time frames, test other styles to see if they work. Now let's talk about the most important concept of this video, that is multiple time frame analysis. Now the multi-time frame analysis or the multiple time frame analysis is nothing but an analysis on multiple time frame charts of a single stock or an instrument. Now there are two major rules for multi-time frame analysis. Number one, the larger time frames establish and dominate the trend. What this means is that when a larger time frame trend is in play, you will see pullbacks in the smaller time frames. And these pullbacks in the lower time frames are nothing but noise against the flow of prices. Or in other words, in order to identify the trend, you will always have to look at the higher time frame charts. The trend reversals begin in the smaller time frames first and then propagate upwards to the higher time frames. So this means that we will see a changing market structure showing up on a shorter time frame chart first before it is evident on a longer time frame chart. Now let us focus on what to look for when doing a multiple time frame analysis. Whenever you are planning to take a trade, you have to think about two important factors. Number one, the market trend or the general market sentiment. And number two is the trigger signal for the trade. Let me explain each of them. Identifying the general market trend can help you plan your trades in the direction of the prevailing market sentiment. This way, you can capitalize on the impulse moves and limit your losses by not trading against the flow of the market. Generally, for every trading style mentioned earlier, the overall market trend is given by the higher time frames. The reason for this is that a trend on a longer time frame takes more time to develop, which means that it will take a bigger market move for the price to change course. Also, the support and resistance levels are more significant in longer time frames. Now, some of the general methods used by traders to identify the general market trends includes identifying using the trend lines. So you may already know how to draw trend lines by connecting the swing lows and swing highs in the chart. I have already made a video on market trends, so if you want to learn more, please do check that out. Now the second method is by using the 200 simple moving average. Usually this method is used by traders over the daily time frame, so it can be effective for both swing as well as intraday trading styles. Another method involves the use of technical indicators like MACD, RSI, etc. to spot the long-term trend over a higher time frame that you are trading on. The second factor to consider is the trigger, which is none other than the signal that alerts you of a potential trading opportunity within the context of the overall market trend. The trigger signal can be anything from a breakout or a reversal from a support or resistance level. It can be a popular chart pattern breakout, or it can be based on candlestick analysis. The other popular methods includes the use of technical indicators like moving average crossovers or other indicators such as RSI, MACD, to name a very few. Now, the trigger signal is to be received in the lower time frame of your preferred trading style. It can be any setup of your liking. Now, most of the time, the trigger time frame can be the trade entry time frame as well. Now that we know what to look for in different time frames, let us dig a little deeper into how to do it by taking the multiple time frame analysis approach to a level further. Now, often there are traders who enter their trades on, let's say, 15-minute chart, but their higher time frame is on a monthly time frame, and it's silly. It is like looking for a ring on the ground with an astronomical telescope when you could have used a magnifying glass or simply your naked eyes to spot it. You get the idea, right? It doesn't make sense because both the time frames are too far away. You enter your trades on a 15-minute time frame and then you go to the monthly time frame for your higher time frame analysis. It is actually very irrelevant to you. Or how about this case where your entry time frame for your trades is the daily time frame, but you go down to the 5-minute time frame to time a sniper entry. Now once again, this does not make any sense either, because you are focusing too much on the minute details that are really unrelated to your goal. Anything you observe in a 5-minute time frame will appear to you as noise on a daily time frame. So if we know our trading style and the trigger time frame, how do we decide on a higher time frame? Or conversely, how do we decide on our lower entry time frame if we know our trading style and the market trend analysis time frame? So the method that I am going to discuss is what I have learned from Adam Grims and Dr. Alexander Elder. So the first point is that you have to set your trading style. So you have to decide if you want to be a swing trader or an intraday trader or a positional trader. Now once you know your trading style, you can use a factor of 3 to 6 to decide any time frame. Now let's see how it works. Let's say you are an intraday trader. As I have already mentioned earlier, the most common time frames for trade entry are the 5 minutes or 15 minutes. Let's say you are entering your trades in the 15-minute time frame. Now you can use a factor between 3 and 6. Now you'll take that factor and multiply it by your trading time frame. For example, in the 15-minute time frame, if you multiply it by 4, that's 60 minutes, which is equivalent to a 1-hour time frame. So the 1-hour time frame can be your higher time frame for the 15-minute time that you are entering your trade on. Or if you want to go with a factor of 6, that is also possible. The higher time frame in that case will be 90-minute time frame, which is a factor of 6 for the 15-minute time frame as your trade entry time frame. So anywhere between a factor of 3 to 6 is perfectly fine if you ask me. But what it requires is proper back testing, because a combination of higher and lower time frames that works for me may not necessarily work for you. So you have to find your own sweet spot. Likewise, let's say you are a swing trader and the daily time frame is your trading time frame, and maybe you want to better time your trade entry with precision on a lower time frame. And how do you define what's a suitable lower time frame for you? Well, once again, you can use a factor of 3 to 6. Now try to use the factor that gives you a time frame that is already available in the list of time frames in your trading chart. So in this case, 1 day time frame is approximately 7 hours, and if you use a factor of 6, our lower entry time frame will be 1 hour. So you can now use the 1 hour chart to time your entry better on the daily time frame you are trading on. I hope it makes sense. So bear in mind that when it comes to multiple time frame analysis, anywhere between a factor of 3 to 6 is a sweet spot. But I have specifically seen people use a factor of 5 more commonly, and that too for a reason. Let me also explain that. The logic remains the same. We use a factor of 5 to break up different time frames. So let's say in a month there are around 25 trading days. So if we divide 25 by a factor of 5, we will get 5 days, which is equivalent to 1 week, since the Indian markets are open for 5 days. Now a week has 5 trading days. So if we divide 5 by a factor of 5, we will get 1 day. So 1 day has around 6 hours and 45 minutes of active trading hours when noted from 9:15 am to 3:30 pm. So when we divide this by a factor of 5, you will get 81 minutes. Now even lower time frame becomes this 81 minutes divided by a factor of 5, which is approximately equal to 15 minutes. Let us match these time frames with the trading styles. So for a positional trader, the higher time frame can be 1 month followed by 1 week for the trigger signal, and an even lower time frame of 1 day to enter into positions. Now when it comes to swing traders, the higher time frame can be 1 day with a lower trigger time frame of 1 hour, and your entry time frame can be 15-minute time frame. And finally, in case of an intraday trader, the higher time frame can be the 1 hour time frame with a trigger time frame being 15 minutes and the entry time frame being as low as 5 minutes or 3 minutes. And if I were to mention about scalpers, the higher time frame can be as high as 15 minutes, the trigger time frame can be 5 minutes or 3 minutes, and the entry time frame can be 1 minute time frame. Now the trade exit time frame will not really depend on the time frames, but it will focus on your expectations or your risk to reward. But if you are carrying a very large position, you can always use the lowest entry time frame as your trade exit time frame. Now as I have mentioned earlier, you can always experiment with these time frames yourself, but always keep in mind the type of trader you are and the trading style you follow, and you will not be stranded. Now that you understand the whats and hows of the multiple time frame analysis, let's move a step forward and take an example each for an intraday and swing trading scenario. As we all know, day traders typically have the whole day to monitor charts and therefore can trade with really small time frames. So if you are a day trader, you can identify the market trend and the significant support and resistance levels that come into play during the day's trade on the 1 hour time frame. You can also make use of the 200 simple moving average. In this example, since the price trades predominantly above the 200 moving average and is moving upwards, the trading bias is naturally bullish. Now you can zoom into the 15-minute time frame to spot ideal trigger signals for trades, like a level breakout or a pattern breakout, reversal from levels, indicator signals, so on and so forth. The 15-minute chart allows the traders to get a closer look at how the prices are evolving on the lower time frame. In this example, the uptrend is also apparent in the 15-minute chart, which confirms a upward bias. So you can plan to take an entry when the price reverses from the higher swing low level, which is also a support level. And once the signal is confirmed, you can take a trade at the 15-minute time frame, or you can even move down to the 5-minute time frame or 3-minute time frame for an even better entry in terms of price, only if it matters. Now talking about a swing trading setup. Now swing traders generally tend to have significantly less time to spend monitoring the charts when compared to day traders, and their holding period may be over a day to a few weeks. So swing traders will look at the daily charts to identify the overall market trend and the support and resistance levels. Now along with that, they will also look for chart patterns to be formed on the higher time frame. Now taking this example, in a daily time frame, we can spot that the market is in a downtrend and that the prices are trading below the 200-day simple moving average. So naturally, our bias is towards the sell side. Now zoom into your 1 hour chart to spot short selling trigger signals or trade opportunities. Now we can see that there is a bearish crossover as the 20 moving average crosses below the 50 moving average, which provides us with a trigger signal. Now you have the option to enter the trade at the trigger time frame of 1 hour, or you can choose an even lower time frame like 15 minutes to initiate your sell position. Now let me talk about some advantages of multi-time frame analysis. First of all, the multi-time frame analysis allows a trader to get a micro view of the larger time frames and then fine-tune an entry. An example would be having a pattern on a 1 hour chart, and you can then zoom into a 5-minute chart to confirm a trade entry. The second advantage is that risk can be managed more effectively by combining different time frames. It can help a trader to move the stops on smaller time frames for patterns that complete on larger time frames. And finally, using multiple time frames from higher to lower enables the trader to be aware of the contrary moves or the opposing patterns that form on the smaller time frames, which are against the longer time frame trend. In simple words, it helps you stop trading against the market trend. So to sum things up in order, to choose the best time frame, you have to consider what your trading style is and what trading strategy you wish to follow. These should be the factors which influence the appropriate time frame to be trading on. Thereafter, you can conduct the technical analysis on the appropriate time frames. But always ensure you implement sound risk management in all your trades. So keep learning, keep practicing, and that is it for this video. I hope you learned something new. If you did, please do like the video and subscribe to the channel, and do not forget to press the bell icon so that you won't miss out on any upcoming uploads. I will see you guys in the next video. Till then, see you.